should mortgage rates be even higher if they didn't? But the general expectation is actually rates plummeting in a recession. So real estate did not decline in the majority of recessions. This is absolutely correct. But the question is more why?
Depression. So the depression itself, and maybe it's a combat method for inflation.
Huge spread versus like the energy sector, which then is like benefiting from it. The thing that if something is overvalued doesn't mean it's going to correct. I don't expect undervalued real estate to drop in a recession at all.
Hi, everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Stefan Tsvetkov. Stefan is a founder of Realty Quant, a company that brings data-driven and quantitative technologies to real estate industry. They're on a mission to massive industry values through education, investment, technology, and analytics. Financial engineering turned multifamily investor, analytics speaker, and a live webinar host. And during his finance career, managed 90 billion with a B, derivative portfolio jointly with colleagues. He's featured on multiple podcasts and webinar events, including Elevate Best Ever Real Estate Show, The Apartment Guys, etc. And he's also the host of Finance Meets Real Estate webinar series. And then today, I understand that you're going to be helping us and diving into a lot of the analytics about the market, reading real estate. So thank you so much to be on the show today.
Pleasure to be here.
Can you tell our viewers a little bit about yourself and how did you going on the path of where you at and then creating this pretty unique company here?
Yes, so I'm Eastern European originally. So I came to the States at 22 for grad school, kind of pretty cliche route, right? If you think about it. And so then I worked in finance for about a decade. So like you mentioned, I was managing like a derivatives portfolio, together with like several colleagues. We were trading like equity, interest rate derivatives in finance. So that was my job at the time. So kind of like a very markets, markets finance role. And in the recent few years, I've been a full-time real estate investor, and I've been doing like analytics in the real estate industry as well, both on the property side and the market side. And I've been doing data-driven investing in residential real estate around in the New York City area. And I've been also transitioning to commercial out of state in the Midwest currently.
Got it. That's awesome. Stefan, I understand that you are kind of the math whiz over here. So let's kind of get into just some rapid files in terms of our markets. The biggest news on the market right now is interest rates keep on going up. Now, some of us who are investing, we see this trend that's coming. We know there's inflation, there's going to be interest rate hike in order to compound this. So what is the impact of interest rate going up? And do you have, nobody has crystal ball, but do you have a little bit projections of where the rates are going to go to? I think that's obviously an urgent question where everybody has in their mind.
Yeah, and that's a great question. Well, I used to, like I mentioned, I used to trade interest rates actually before in finance. So it kind of like, they have like a little bit of background. So I can relate to in 2020, for example, I can relate to the ahead of the COVID recession quote, and very short recession, right? But still, like a very 1/4 recession quote. And so ahead of that, like one thing to note about interest rates that will happen is that the interest rates, the way we knew as finance professionals at the time and trading the market that, okay, we are in a recession that just hasn't been measured yet in like GDP, 2 consecutive quarters of GDP slowdown terms, let's say. But the way we knew it was, okay, it's the bond market had a huge rally. So interest rates sort of really plummeted like at the end of January and like beginning of February already. So the time was already, okay, it's looks like it's a recession, like such a huge bond rally heavily correlates with the recession. So that's like one comment on interest rates. So it's really, they're going up, but they were going up in 2018 with the Fed was hiking rates. And then in 2019, the yield curve inverted. And now the whole inversion has like all these other comments of, okay, what portion of the treasuries and yield curve is actually held by the Fed themselves. And then there was like an article I read today, like New York Fed holds like, I think like around 38% of the 2 to 10 year treasury security. Oh, wow. So then it becomes kind of a question of, okay, what's the impact of that on mortgage rates? Now, if Fed holds kind of like a position in that, and like should mortgage rates be even higher if they didn't, like, or something like that. But really, like the interest rates side. So okay, in 2019, then the yield curve inverted, and interestingly, that yield curve inversion predicted, which historically has generally predicted recessions, now with the exception of Russian debt crisis in 98, for example, but the yield curve inverted, and then it did succeed to predict what it was a pandemic-caused recession, which, okay, how that works, I have no idea. Maybe it was random, maybe there would have been another recession or something like that, but it ended up also not failing just on the historical record. So 2019 inversion, and so after so there was an inversion and then sort of a bond rally into recession. So that's kind of the dynamic that, at least for me, is my baseline scenario now. So there are the rate hikes. So the treasuries, the 10-year treasury, then reflects those rate hike expectations, which I believe as of prior to April, the rate hike expectations were around 325 basis points total. Now it seems like they've been reducing a little bit, like those expectations, but generally that's what happens. So rates go up with the Fed hiking rates, trying to sort of save the economy, but then they will hike rates only that much. And then the moment they stop, then the general trend, and of course nobody can predict the future, but the general expectation is actually rates plummeting in a recession. So that's something I say to my real estate investor friends, where they're like very concerned, okay, see if interest rates are going to go forever up. But yes, they are going up now, but it's really what happens, such as rate hiking, rate curve inversion, subsequent bond rally, and then we're in a recession. So that's kind of like the usual cycle. And so that's like my personal kind of baseline scenario on interest rates in that sense.
Yeah, and then if we look at the 1970s, where the last time where inflation has gone up to the rate where it is right now, and then it took, some will say maybe that wasn't the reason why it went down, but it took Volcker. People always credit Volcker to be, helping with that inflation rate by hiking up the interest rate to, I think, almost 20% or something like that, right? In order to curb that. Some economy would say that was not the reason why it was curbed. But do you see that interest rate going up to that drastic measure, or do you think it's more going to be around 2 to 3% here now, going up to that point, and then it's probably might be enough because it would drive the economy down to depression?
I mean, it's hard to say. I think it's gonna depend on really, I guess, like if we start entering a recession or not, and like this kind of perspective. But it's really well, on that thing, let's say now what are the biggest predictors now of like the recession expectation that currently everybody has? Like it's the yield curve inversion and then consumer confidence, right? So those are the two that are now yield curve inversion is now in some models, they don't know how they derive the probability since they're having that many yield curve inversions in the past, but it's, let's say, 2/3 probability of a recession within 12 months and then 98% within 24 months, right? That was kind of like what was around the articles, like even like mainstream articles, right, on the topic. And so, but then there's another nuance to that, that the stock market historically peaked 3 to 12 months before a recession following a yield curve inversion. Now the stock market already peaked, don't hold me to that, but I think it's already 5 months ago at least. That was the peak. So unless we now get like some kind of reversal, which doesn't seem too likely, but never know, like then it could be kind of like 7 months ahead. It's kind of hard to say, but that's like, let's say very, just like if the history like exactly matches or something, it can be completely different as well. But generally it doesn't seem to be an overly long timeline for that. Now the rate hikes, there are like that many FOMC meetings or Fed meetings to happen. So the rate hikes, they really, could, we can have a few, and like they've been kind of planning to raise like with 50 basis points per meeting, right? So it's kind of could get to a certain level. It's hard to say. Like I wouldn't expect to get too high myself, but it's really hard to say. So
yeah, but it's really kind of interest rate hike is not really the biggest combat to inflation. What Fed's trying to hope for is increase the interest rate high enough it affects the consumer, confidence, and also getting some of parts of the, let's say, real estate sectors, et cetera, come down a little bit more. And then it essentially would drive the economy to a depression. So the depression itself, and maybe it's combat method for inflation, because that will slow down the economy and hopefully slow down the inflation over here.
Absolutely. And that is the case indeed, actually, in the 70s, actually, because when we had when there was a recession, like with the super high inflation at the time, and it didn't, it's not like the recession prevented inflation plummeted in the recession. So that's like the other thing, like with people being very concerned about either interest rates or recession, but they both tend to really go down once the economy kind of slows down. So this is like this is kind of my general expectation, but of course it's hard to predict the future, but that is my baseline scenario. Now mortgage rates is many of some of your audience might know mortgage rates are primarily tied to the 10-year treasury rate. It's like people, they don't hold their mortgages for 30 years, right? Kind of, and the 10-year rate is a pretty important rate in the first place. So it kind of they correlate highs to the 10-year rate. So the 10-year rate has been responding to to the rate hike expectations, and it appears perhaps those rate hike expectations subsided a little bit, and some of the probabilities I think reduced because 10-year rate pulled back recently to its level a little over a month ago. So, and with that, mortgage rates reacted a little less, and they kind of are a little bit less down than the 10-year rate is. So, so it's been this kind of dynamic. But now, of course, perhaps the general trend of interest rates is still up at the current time. But that is, that's kind of the situation now. I don't know if they would go way too high, interest rates. It's hard to say, but it will stop whenever the recession. So,
it's cyclic and whatnot over here. And then I noted that over here was the interest rate hike. We kind of talk about that. But now, Stephen, do you have any other data to show that potentially, because we're kind of talking about data-driven items over here, do you have some data to show, do you really think economy is doing well right now? I mean, one thing is about the inflation, but do you think economy is doing well? And then what is your strategy in this inflationary scenario where the rate is also going up? Essentially, you kind of have a little bit of double whammy, and not to mention the China lockdown with the supply chain, supply chain impact over there as well.
Well, myself is, that's a great question, actually. I mean, myself is, again, going generally transition to a real estate industry. I think I have a stronger view that is intuition about the data from looking at the various real estate markets, kind of, and getting a sense of, okay, are they over, under, fairly valued? So what is the downside risk in various markets, assuming we enter a recession, let's say. And so that's kind of where I feel I have more focus. Now, as far as the broad economy, I mean, I'm not an economist, but I just pulled in front of myself, there's a dashboard that was from around 1-2 months ago for, I mean, the most bearish kind of negative signals that are in the current economy, as to whether it's a strong or weak one, let's say, is, well, it's, we mentioned yield curve, consumer sentiment, and now in the inflation, right? Now, there's some positives that have been employment gains, jobless claims are at historic low, savings are high. That could be expected at this point in the cycle, but and so forth. So they're having some positives. Now we saw the technology sector kind of tumble with, because actually technology stocks, they do really poorly at high inflation, right? That's been seen in the 70s. So in the 70s, growth stocks heavily underperformed value stocks. So that was the weakest companies, the weakest technology companies in terms of earnings, their earnings even further suffered. They started getting even more unprofitable with inflation. And second, now their valuations were totally phony, perhaps you can say. And so now they, let's say there's some kind of method to them. And now interest rates kind of went up and those valuations went totally off, it seems. So that's kind of a lot of the small cap technology, based on at least my following of different financial commentators on LinkedIn, I can connect you to some of them, actually was okay. It's very much driven by, just the interest rate spike. Now, then that kind of a little bit went into the bigger cap technology as well. And there's a huge spread versus the energy sector, which then is benefiting from inflation, in this kind of perspective. Yeah, so there's a mix of, there are some relatively bullish things. Am I bullish? Maybe no, but I'm
You're not
European.
as grim. Yeah, on the economy.
How
That's
many
maybe what I would
European
hope you are.
how many
Yeah.
European finance people who are bullish about the economy? So it's like that's kind of the joke, but so that's kind of that's the perspective. But on the real estate market, I can make like more commentary actually in terms of that.
Yeah, that's very interesting. So I love kind of what you just said over there, and I want to kind of tease it out and make this generalization. You mentioned before during this period time was inflationary period time, the technology stocks or the growth stock typically do less than the value stock, and value stock really, when we translate it into real estate investing, it's kind of like the cash flow, right? It's like the cash flow yield type of a assets or whatnot that tend to do well, and the company is a kind of the asset as well. But by like the growth is almost like this, maybe like a value add or this like new construction, like something that is more written on equity versus cash flow. Is that like a good assumption and generalization to kind of summarize that up when we're looking at a pattern both in the stock market or asset across all assets, what we should be kind of looking at?
Yeah, I think that's very good actually. And yeah, it's an interesting comparison of like real estate and let's say value investing. And in that sense, I mean, it's a little bit, like in finance, like real estate stocks, they actually have some of the highest price earnings ratios. So which is interesting, but that's kind of like, it's pointing to the tax benefits of real estate, right? That we see as like private investors, because it's really the earnings become meaningless. I was actually looking at like perhaps like last week at like the S&P 500, like the top price earnings ratio out of all 500 companies, it's the real estate investment trust, UDR. And so it's just because, okay, earnings are kind of meaningless, they've just, you have to add back depreciation to them. And okay, that's like, okay, financial analysts, perhaps they know it, they, look at those companies in terms of, I think, FFO, or I don't know what's the measure, like it's kind of adding back depreciation or something like that.
Gotcha.
But really, absolutely, like real estate has been a short-term beneficiary of inflation. And I've been hearing a lot of comments on Facebook, on LinkedIn, from people, like who would say, okay, buy hard assets because there is inflation, but that is what is driving real estate overvalued in some Western and Southern markets right now. And so when I say overvalued, it's not actually just a statement where, okay, it's just like a phony statement that doesn't mean anything. It's just in very numeric terms. It deviated, like valuations, fundamental valuations deviated from their historic levels in the middle of 2021 with inflation. And so that's been kind of like what I've been seeing. And that's something that we track under Realty Quant, because like Realty Quant actually on the market side is a market data code provider. One thing that we provide is actually market valuations for, okay, which markets are over, under, fairly valued. And so that's kind of what we do. So it's kind of like a quarterly, like every single quarter changing data. And so it was very different picture before mid 2021.
Got it. And then so from what you kind of derive over here, we should be expecting a valuation decreases over here. Now, is there some prediction on like what valuation discounts perhaps what we're seeing? Obviously, each market is very different, but let's just say very dear to our heart, Phoenix market or Dallas market, Texas market, which is being real estate hot markets, especially for commercial. We've seen, I don't even know, I didn't track the pricing over here, but we've seen some pretty big jumps in terms of positive gaining on valuation. So when you're looking at dialing it back, because when we're looking at the cycle, each cycle is always higher, long-term hold, each cycle is always higher, because, inflationary scenarios a longer period of time. So what would you predict the valuation when we hit the depression, and when it comes down to, where do you think, I'm not going to hold your feet to the fire, but where do you think that valuation discount, what we're expecting over here?
Well, so you're in Phoenix and Dallas, or?
Yes, we are.
Okay, well, I mean, yes, so that's, so you've had a really great time, I would say,
yes,
in those markets, like
good parties, yes.
It's done like incredibly well, right? So, well, okay, I mean, it's, I don't know if there is, I don't know if a recession necessarily causes discounts, but I can say like the following. So let's say, so I pulled the data for like 45 years back, and actually I have the data for every single county in the US, so 2,700 US counties. So now, and just the concept is, and you can do it yourself, the concept is just fundamental analysis of the prices based on income, population, and housing supply. Now, and the test for whether it works is I used like the global financial crisis kind of back study, and I computed like those valuations at the peak in every single region at the peak. And then the test for whether it works, was, okay, is it which measure, and I was looking at different measures actually at the time, but which measure, in this case, this one deviation from population, income, population, housing supply fundamentals correlates to the declines that happen subsequently in those regions, where those declines, they take, let's say, 4 years. So that's so just trying to the predicted variable is the declines, right? I mean, you get it in this sense. And so that was like that was kind of the study. So now one thing to note on that. So I saw like some charts online where people say, okay, real estate did not decline in the majority of recessions. This is absolutely correct.
Yeah.
But the question is more why? Because so I don't have like good price history before 1975 myself. I mean, I could do it just for broad US or something, but I kind of started 1975. So 45 years back, it's 47. So from that point, it's hard, I don't have sufficient history to assess, let's say 1980, 1981 recessions, but then 1991, because it's just too close, 1991 and 2001 recession, there's basically no drop to real estate, to the broad US real estate market. And so, but if you look at the valuations, so the same valuations that they compute for GFC for now as well, the US real estate was actually even slightly undervalued both times. So it was negative, it was like below its fundamentals. Now, undervalued real estate doesn't drop in recessions. That's been seen during global financial crisis. There were around 12 states in global financial crisis that were undervalued, including Texas at the time, by the way. And they had an average drop of 4%. 4% was also incomes kind of drop in a recession. So let's say one can look at it in normalized by income terms. It's like valuations kind of don't drop as if, kind of like stay the same. So it's like something like this. So it's actually, so I don't expect undervalued real estate to drop in a recession at all. Fairly valued could, if there's a very broad correction and just kind of randomly, okay, something that's fairly valued could go a little bit down. And that was the case then as well. Fairly valued markets did drop during global financial crisis. And then overvalued ones dropped a lot. And so, but the prior recessions, US real estate were actually below its fundamentals. And then it came to GFC, US real estate was 20% above its fundamentals, and the broad nationwide drop was around 20%, actually roughly the same. And then there were like 4 states that were very overvalued: California, Florida, Arizona, and Nevada. And they were like in like 40 to 60% positive valuation, like overvalued compared to their historical trend. And they dropped actually very much in line. So like 41 to 56%. And all the undervalued ones, like I mentioned, were like just like a 4% and drop. And it kind of gets too many numbers here. But then it's right. So that's so my expectation, again, like in this sense, I definitely don't expect undervalued markets to decline, because that just doesn't seem to happen with real estate. Real estate is very sticky on the downside. It's not like the stock market, like prices kind of stay the same. So like when people say, like, for example, if interest rates are rising, and they say that could put downward pressure to prices, I don't think it does. I think it does for markets that are overvalued. I think otherwise prices stay the same. And so now the question now to your question, now which markets are overvalued? Well, let's start with just like quickly, like let's start with like through the beginning of 2021. So there were like different studies. There's Bloomberg Economics. They published a study for different countries, published by an economist called Niraj Shah. And then there were like other studies. And so beginning of 2021, US real estate was fairly valued, like right around 100. It's quite interesting. Like most people thought it's very expensive at the time, but broadly, like nationwide, right on around 100. And and on the contrary, like Canada, and that they're the so-called scans economies. So scans economies they're like commodity exporters with independent central banks, like so Canada, Sweden, Australia, Norway, New Zealand. So they had very overvalued real estate. That's been since 2018. And so Canada was like around, let's say 150% or something, like 50% above.
Yeah.
And US is
Wow.
right at 100. Now US changed afterwards. And so I was tracking the same metrics like for every county, like since beginning of COVID when I started doing this thing. And so I had like, those metrics for that period. I was tracking every quarter and they were roughly the same. And they kind of doubled in the middle of 2021 and have been increasing. And perhaps that may slow down now with the mortgage rates, kind of not to stop perhaps increasing that much valuations in that sense. But they kind of increased. And so what happened is that before 2021, only Idaho was the only kind of state that was COVID overvalued, like above more than 20%, let's say, or like sharper kind of overvalued. And there were, like very well-performing states like Texas and Florida were like 8 to 10% valuation positive for like 4 years consistently. And the same 8 to 10% is now 22% for Florida and Texas. So that's kind of the change with inflation that people are seeing. But generally it is Western states. I don't want to get into specific markets, but Western states, the 6 states to the west, like Idaho, Arizona, Nevada, Utah, Colorado, Washington, kind of, and then to some extent, Florida and Texas, to a lesser extent, perhaps than those smaller Western states, have some degree of overvaluation. Now, it doesn't mean it's really bad, but there is they have also performed the best. So they're the best markets. So it's also around appreciation forecast for them, it's the best appreciation forecast, but it's just something to consider. There's also like the thing that if something is overvalued doesn't mean it's going to correct. Prices could also in theory stay the same or not, I would say, we could have like income super growth. That was kind of some of my hope with inflation, that inflation drove some of the asset prices above their fundamentals, but if really income catches up, then that could resolve partially at least. But so far it hasn't happened. Now, if income, let's say, was to experience some kind of super growth, to grow really strongly, then some of that could resolve. If also on the contrary, prices don't decline, but let's say they become kind of stagnant or they just stay the same for a few years, and then income catches up, then that could be another way to kind of leave the overvaluation. And those are very possible scenarios really with real estate. So it's not like a particular.
Yeah, so it's very interesting because in the last 1.5 months, because the interest rate increase has been probably hit at a critical point over here, a lot of capital has sitting on the side. So therefore, the real estate market, specifically to commercial, the ones that we're in, we have actually experienced a lot of retrade that's happening. And then the general discounts about anywhere between 1% to 10% in terms of asset retrade rates. So what's being done, it was about a 1 to 3%, the retrade rates, what ended up getting done. People are requesting for up to 10% of discount on things. So we definitely see this is really happening all at the same time. That being said, if last year things has, in some markets has really doubled in valuation, et cetera, which is pretty crazy. And with a 10% discount, you're still in the positive.
That is correct. No, that is correct. And actually another thing, like just to add to like what you mentioned, of course, to the extent when one gets a deal on the property side, that some of that risk gets moderated, right? Very much. And also this is really, it's really the broad housing market. So then there can be a question as to how commercial multifamily stands relative to that.
Right. Yeah, relatively to the rest of the asset types, such as industrials, commercial, or single family specifically. I think that's probably what people understood. Yeah.
Yes, because again, like this is like this is really based on just like broad housing data, like government housing data. That's not commercial multifamily. Now I had done like a simple like regression to see like commercial multifamily, like CoStar index versus like some of the residential ones, like historically, and they have like a 91% price correlation. So they're not, like totally off, but it is very different because we have seen like after the global financial crisis, we have seen a much smaller decline in commercial multifamily. But then still, just for the record, because I do hear like many sponsors kind of say, okay, commercial multifamily is different, even if real estate is overvalued maybe commercial multifamily is just going to be just fine, but it's not necessarily. Could be that commercial multifamily could be more overvalued in some markets. It's just I don't have the data to track it, so it could go either way. It's not. If you have like excessive rent growth, for example, that could result in that situation, commercial multifamily relative to residential. So it's just I am not able to well comment. I kind of track it intuitively as myself. I look at commercial assets as an investor, and I do use the general housing market a little bit as a proxy. I know they're not the same, but I do track kind of intuitively, and I also track like the deals that people do on the commercial side there and try to see, okay, does it seem like it's moving in line? And I just know that, let's say, some of the rent growth that happened in Western markets did coincide with the residential housing valuations moving up as well. So there is some kind of overlap. But again, they're not the same. We know that commercial multifamily was, to an extent resilient in like a housing decline past global financial crisis. The housing valuations are not nearly as bad as they were then as well. They're about halfway, I would say. So it's not.
And then in the last recession, when this happened, I know each state is different, each city is different, even each submarket is different. But in general, is there a data reference points to look at how much the delta of like the single family drop look like, and then the versus the commercial, like multifamily specifically? Is one kind of fared better than the other?
Well, for myself, I don't have it because I'm not sure. Let's say I'm sure you guys have, let's say, CoStar, right? And now do you have? It's just there like certain primary markets. Like one could compare for certain primary markets, of course, in that sense, and kind of the delta there for like all those like a bunch of cities. And in that sense, I take kind of a broader view, like I said, since I kind of like I literally pull like every single county in the country. So I would not be able to do a broader comparison versus commercial, since I just think there is not going to be that much commercial data, But for specific, markets like they say Atlanta, Georgia, or so on and so forth, like very specific cities, I'm sure one would be able to do that. That's an interesting study.
Yeah, definitely. Awesome. Yeah, because I think now I'm gonna ask a very novice question over here, because on your blog over here, you kind of talked about, one of your blog is talking about US real estate peak to peak price changes. And then you have kind of put this article, which you've written last year, best performing US real estate market since fair valuation. And then you kind of highlighted a few of these markets and you listed out the worst performers and the best performers. Now, theoretically, would someone just kind of take on these worst performers and go through this and check with the fundamentals of the population growth and etc.? Well, honestly, the ones that over here I can see, except for New Mexico, perhaps like everyone else is, traditionally a very low growth state, versus the one that was fair valuation to current price changes are pretty drastic. So would someone kind of take your worst performance and trying to like pick something out of that and say, okay, assuming these are going to be undervalued and are probably going to be protecting my asset a little bit better? Or should someone's kind of like picking essentially the tier 2 markets on the left-hand side, which is your one that grow the most, or it's kind of hard to say?
So that's a great question. So the valuations in terms of, let's say, where the market is valued is a good predictor of downside risk. It's actually to the degree of like 85% or so correlation at the state level. Now, is it a good predictor of appreciation? No. It's like I tested it and it's maybe like around 12% or something. So there's like a mild positive. If something is undervalued, is it going to do well in the future? No, it's generally not. So that's like a very important thing. And that's also the opposite. So some people think like sometimes if I say, let's say I've been talking about Idaho since 2020. So since 2020, like I mentioned, Idaho has been kind of like overvalued. And so people would think I'm bearish on Idaho. What they don't know is I run appreciation forecasts, and Idaho, and Boise specifically in Idaho, the best performing city in America this market cycle, was at the top of my appreciation forecast if I am to forecast 1 year ahead appreciation. Simultaneously, it's overvalued. So those are different things. So valuation is a very good predictor, very strong predictor in real estate of downside risk. Of upside, no. Like things that are overvalued, they continue going up. The reason for this, I think, is momentum. And it's that if one tests autocorrelation in all the markets, for example, let's say one takes Florida, right, at the state level, autocorrelation like 77%. So the correlation of this year price growth versus last year price growth, very high, 77%. Massachusetts was like 79, so there's a strong momentum. So things that perform well, they continue performing well. Now, if you want to pick the best markets, in my opinion, what is a good approach is the following. So I did like a study where, okay, I take population income growth, population growth, housing supply growth, and I forecast them separately. Like I try to forecast population, try to forecast, and like there can be like there's like Facebook profit is one model. There is, like exponential triple smoothing, like ARIMA, like different, just that they're pretty mostly like older statistical models. And then besides the Facebook one, let's say. And so just like to forecast ahead, right? It's not like super useful, but let's see. Okay. And so, and if you forecast the fundamentals and then off of those fundamentals forecast the real estate prices, I had a 5 times bigger error than if I just forecast the prices themselves. That's one thing to note. So if you think about like the inherent approach in which most investors pick markets, they say it has this population growth, maybe job growth, like all those parameters. Yeah. And that's okay. It works well enough. It works well enough. But if one wants to get super precise on where it's going to be the best appreciation, because of the presence of momentum and autocorrelation, you want to be forecasting the prices themselves. And that's kind of what I've seen. So there's like an interesting kind of like insight on that side. So now if one but that's because we are also fairly further in the market cycle and we already have kind of price histories. So like to your point, if let's say some markets are, to your point, are undervalued and they also happen to be the ones that are not performing well, right? Are they gonna forecast good appreciation? No. Now, if we were, let's say prices were to decline, like, in a recession, and now all those valuations kind of resolve and perhaps some things even go a little bit undervalued. At that point, we have no price history in this market cycle in terms of momentum. It just has to start kind of fresh. And so we need to just like forecast, do that second approach that I mentioned, like forecast then the fundamentals, like the population, income, and so forth, and off them forecast the prices, right? And so that would be the best thing to do at that time. Now, once we're already in a cycle, like now it's very easy to predict next year appreciation, assuming we have like, I actually did like a forecast for 2018, 2019 prices based on like 45-year histories. And whenever we're within the same trend, which was like 2018, 2019, the error just for states, this is very high level, was like 1.4% of the true prices. You know? Wow. And so it's actually, so one can do it, but then that breaks the moment the trend changes, right? So then the trend changed in 2021 with inflation. And so that breaks. But then if it does break, then you will see that in your downside risk predictor and your valuation. And so then you kind of get that as well. So it's like the two things for me are like that's actually how I pick markets. Like I've done like with my own webinar, I sometimes like lecture on like how to pick markets. So that's like for me, forecasting appreciation is like best done. Just look at the price histories, honestly, even better than the fundamentals. So I can kind of look at them on the side, okay, as a check, but really, sanity check, but really the best way is just that. And yeah, so things that have performed well, even if they're overvalued, they continue performing well. But at some point, if there is a trigger, and that could be interest rates, then that could change. And so that has been like my discussion with like very much specifically primarily Idaho, where Idaho is really standing up, kind of above everything else like for a while. And so Idaho is like, I think at like plus 50% overvalued at the current time. Actually, it's like pretty crazy. And like Boise in Idaho is even more. And Boise is the best performing city. And I've been talking to like few people like who are in Idaho actually. And, they seem to think that, they seem to think that if you do like a simple model like this, you're not going to be able to capture all the stuff that's driving that market forward. I don't think that's true, because suppose that there's like all those new technology quants or so forth, like jobs and so forth that are developing in the market, quite in Austin, so forth. It's going to get reflected in the income, in the population of that place subsequently. So it's going to have to go there in that data, in my opinion. And so if it doesn't, then that's strange. So then that's kind of, there is something there. And so, so that's kind of like an example. But again, like Boise is also the best performing one. So the highest appreciation forecast, also highest downside risk.
Okay, because it kind of goes the cyclic in terms of that. That's very interesting. Well, awesome, Stefan. I totally expected a super deep dive into this. I think we definitely invite you over and talk about more specifically on market. I learned a lot of myself over here. How does people find more about this great data stuff that you have offer, and then about the Realty Quant?
Yeah, great question. So on the market side, it's published at realtyquant.com. So we have like a quarterly, like it's like it gets updated quarterly, like to people. So just like forever, like in perpetuity. So it kind of, because it changes, right? So you need to kind of have it like updated all the time, like what if it goes like more or less undervalued and so forth. That's on the market side. On the property side, so realtyquant.com. On the property side, I don't have a product yet. I'm looking to release like a commercial multifamily, like some off-market financial modeling for commercial multifamily. It hasn't been there yet. So for the time being, it's just the market data, and everything else I just use in-house. Like I do like property analytics and so forth as an investor myself. So
yeah, that's awesome. So you can find Stefan and his company on, I will put the link below over here, at the realtyquant, .com, and they have, looks like there's an economy or so over there, and he writes pretty data-driven blogs and webinars and etc. For us to consume over there too. So that's awesome, Stefan. Thank you so much for your data-driven, approach to the real estate stuff. We definitely learned a lot in the session. All right, this wraps up another 10,000 Roads to Financial Independence, and we'll see you next time.